Hello everyone, good evening. This is Waris Karim again with a managerial accounting presentation. This is primarily for my Accounting 219 managerial accounting students at Alabama A&M University. Hello guys, tonight we're going to solve one problem, the foundational 15 from chapter 5, from cost volume profit analysis chapter. As I told you before, that at the end of every chapter, they have one review problem and also one so-called the foundational 15. So there will be 15 requirements for each of these set of questions, and we are going to solve all 15. All right. So the way the problem has been designed is that it is presented as a contribution format income statement. So a contribution format income statement is one where we have sales revenue, then minus variable expenses, which gives us contribution margin. This is for all the operations, for the total operation. This is not on a per unit basis. So we have sales revenue for the whole organization for the period, minus variable expenses, that gives us contribution margin for the whole operations, and then minus fixed costs for the period, again for the whole business. That leads us to net operating income or net income. All right, we don't call it net income because there could be financial expenses or other income and expenses and revenues and gains. All right, so let's not get there. Let's limit ourselves to net operating income. In finance terms, this is earnings before interest and taxes. All right, so what we have here is an income statement in the contribution format. In the regular format, we would have had sales revenue minus cost of goods sold. That would have given us gross profit minus operating expenses. That would have given us operating profit, the same operating profit. But here we subtract or we classify costs or expenses by their variability, by behavior. If a particular expense is variable, usually material and labor, and variable expenses or variable overhead, if there is any, and even if selling expenses, administrative expenses, anything that is variable is going to be under variable expenses in a contribution format income statement. But anything as selling or administrative would not have been constituted, would not have been included in cost of goods sold, in the cost of goods sold or traditional income statement. The traditional income statement format is one where we would have had sales revenue minus cost of goods sold. Remember, cost of goods sold, and those cost of goods sold could include variable expenses as well as fixed expenses. Remember how we used to get cost of goods sold in our job order costing and process costing. Cost of goods sold would include material, labor, and also manufacturing overhead, applied manufacturing overhead. So manufacturing overhead, we know, would be by and large fixed. So in a contribution format income statement, would not have those. Would have revenue minus variable expenses, be it material, labor, overhead, or selling or administrative. Anything that is variable would be excluded first to get to contribution margin, and then from contribution margin would subtract all fixed costs. So that would include fixed manufacturing, fixed selling and distribution, and fixed general and administrative expenses. But the operating income under the contribution format and under traditional format would be the same. All right. So that's how they presented it. And they also told us that this is for a 1,000 unit operation level. So right now the company has been producing and selling, or maybe just selling 1,000 units. And the relevant range is also given. The relevant range is 500 to 1,500. That means the numbers, the cost, the variability, for example, the fixed cost is going to remain fixed, is going to remain at this level. The current level is $6,000. It would remain $6,000 from 500 units all the way up to 1,500 units. So even if we have more sales, right now we're selling 1,000 units, but if we increase it, if it grows to 1,500 units, it will still be the same $6,000. So let's take a pause right now and